Welcome to Real Estate Accredited, a weekly meetup where we talk about topics of real estate as well as educational platform and networking. I'm your co-host, Jeff Rodriguez, joined by my co-host, Philip Shilligan and Rajiv Menon. We are also co-founders of Boost Capital Group, a real estate investment firm that focuses on helping busy professionals invest passively into real estate assets in commercial. If you don't have any questions, or if you have questions, feel free to drop them into the chat as we move forward. We want it to be engaging. Feel free to stop us, ask the questions, type it in. We'll be watching, monitoring the chat. Philip, whenever you're ready, go ahead and kick it off.
All right, thank you, Jeff.
Yep.
Okay, today we will talk about how to perform high-level property analysis. And as usual, our focus is on commercial multifamily, value add, in place. Prepared a few slides as usual, and don't hesitate, as Jeff mentioned, to ask a question. We're a small group here. You can just unmute yourself and ask the question if you have any, or type it in the chat, and we'll do the best to answer you. It's pretty short today. Was there a question?
No, it was a sneeze.
Okay. Okay.
Bless you.
Bless you.
Oh, I'm sorry.
Okay. Yeah, no worries. No worries. So the first thing to think about is how big of a deal you can go after. And it's something I often discuss with my students in our first calls. You have to realize when you're looking at a deal, between 30% to 50% of the purchase price, that's the amount of equity that you're going to have to bring to the table. And that's going to include the down payment for the loan. That's going to include your renovations, in some cases, closing costs, acquisition fees, and other due diligence fees like inspections and whatnot, and loan application fee, etc.
Quick question. So that seems like a large amount. So does the down payment consist of 20 or 25%, and the others making up the remaining 25?
These days, down payment is probably more around 35% because the interest rates are higher. So that's why I used to say 30 to 40%, but now I pushed 30 to 50% because of that. So indeed, let's say in a more lower interest rates, you probably have between 20 and 25% down payment. And then you would have maybe 5 to 10% on renovations. And also, again, you have the closing fees, etc. And I think here I have an example of a breakdown, CapEx budget. So you see the acquisition itself is 5.3 in this example. It's a deal we're looking at that's located in Augusta, Georgia. And in that case, like the CapEx budget was about a little above 10% of the acquisition. We had, in the same order of magnitude, we have a little bit of reserve, of actually a tenth of that. We had that for reserves. And then if you look at this, that's 230,000. Maybe, what is it, 5% approximately for closing costs and fees and legal, etc. So when you add, I could have broken down the equity, but basically here, the down payment. But the down payment will be the 2.4 minus all these numbers here.
So what item are you accounting for the acquisition fees, like the syndicators fees and everything?
Can you repeat the question? I didn't hear you, Rajiv.
Oh, what line item? Sorry.
Oh, line item. Okay. Yeah, it would be in the fees. It would be in the fees.
Oh, it comes in the fees.
Yeah, it comes in the fees. Okay. But it's bundled. You have the acquisition fee and the loan fee. Okay. There are different ways to present these things. But here, if you add up the down payment plus all these fees and the capex, then in this particular case, we get to 2.3. And actually, my math is wrong because I'm talking about the purchase price here. So let me fix this actually. That would be 5.3. Right. Let's redo the math live. So we're going to be closer. Yeah, I'll be a little higher. 24, 3 divided by 5% in that case.
Yeah.
Okay. There's no other question, but that's a good point. We need to break down here. So now, and I think it's, if you think, okay, so I need about 30 to 50%, and let's say these days 45%. So let's count it like 50%. Okay, so now.
So one more question. Sorry, yeah. I keep interrupting right in the middle of your thoughts. So all of these, the uses that you say, the acquisition and the capex, is that for over a 5-year or over the life of the project, or
correct?
Is it like a 1-year outlook?
It would be for the whole 5 years.
Okay.
That's the 5 years, yeah. That's the whole, because otherwise that would imply that you're going to, in your business plan, you plan to add capital down the road, which is very unusual. It's not, if you do a capital call, is that the deal doesn't work too well.
Okay.
And it's certainly, if you have a variable rate, for instance, that could be probably a reason to do a capital call, that because the rate is much higher than what you anticipated. So again, let's for the sake of discussion, let's use 50%. And so it means in this case, we are going after a $5 million deal. We need to bring about 2.5. But now the question is, okay, where am I going to find this money? And because we talk about syndications, in order to bring the equity together, so we're going to have individual investors. But if you think about it, if it's your first time, you probably have to consider talking to people and have them soft commit at least on the idea of investing at least 1.5 to 2 times what you need to raise. Right? In the prior example, we are talking about a $5 million deal, and you need $2.5 million equity. So you probably should plan to have people in your network from whom you can raise $5 million.
So if you're looking to raise 2.5 and you want to raise 2x, it's about 5 million. So assuming, say, an investor invests about 50,000. So you're looking about 100 investors, right?
Yeah, it's possible. Yeah, absolutely. Again, in that case, you would try to raise the minimum to 75 or 100,000 to have less investors, because then it becomes complicated. And obviously, I think now you have to flip. If you're considering, let's say, doing a deal by yourself, so now you're going to say, okay, let's see, I have some friends, maybe between, and I have a little bit of money. Let's say I can bring $1 million between my own money and people I know. I feel I can bring $1 million. So if you want to be conservative following this rule here, you're going to say, really, I should look at any particular property where I need to bring only like $500,000 to purchase that property, which is, and now if you go back to this rule, for $500,000, you're looking at $1 million property in that case, from a deal sizing standpoint.
Yeah.
Like the rough numbers, but just to have an idea. So if you can, and that's why often what happens for people who are beginning in the area, they're going to partner. And when you bring like several people together and we have their own network, so that's when you can go after
a bigger deal
properties. But you can see, I think the flip side of that, now you can see that if you want to be active, it's not only looking for the deal. So now you have to think about equity and working with partners. And I think it's something that becomes complicated, more complex pretty quickly. And that's why I think at the end of the day, the real smart move, if you can, is to be passive investor. All right. So next, and that's something that I came up with that by myself. So you will not find in any book or podcast or anything. This is something I just discussed with my students. And from observations of looking at many deals, hundreds for sure until now. And so here the idea is when you have an offering memorandum, the OM, offering memorandum, which means the document that is prepared by the real estate broker with selling the property, they are typically going to show you a pro forma. And in that pro forma, they're going to show you the late income. Here it's a T1, meaning it's a 1 month that has been annualized, so multiplied by 12. And they will show you also typically the typical expenses. And usually, and that's Arcadia, it's a pretty serious group. They've replaced the particulars of that property with a pro forma on expenses, because sometimes it deviates. But that's not the point. I don't want to go too deep in the weeds of this. What's interesting is that you want to compare the T12 so trailing 12 months net operating income, which is the bottom line. And let's say in this case, we'll consider it's going to be this starting point here, this number, the 887,000. And you compare that to the pro forma of what can be done, how far you can push the property. So you compare the $220,000 to the 887,000. And if you just do a simple division, you'll find 1.38, meaning that the $1.2 million is 1.38 times bigger than 887 or 38% bigger. So if you follow my filter rule here of 40%, so here you are in more or less in line, you're increasing 38%. So for me, it would be a deal that is worth taking a closer look at, because sometimes people are saying properties that are fully renovated, and but not much you can do. So it's like a performing asset. Just like if you're buying a turnkey property, everything has been done. You don't have to worry about anything. And you're buying that for cash flow, not appreciation. But when you do a syndication, you have to increase the value to force the appreciation. And in order to do that, you're going to increase the NOI.
So a couple of questions. So a couple of questions. These seem to be very important numbers to make a decision on. The second column, the T1 annualized, is provided by the broker, right? And can you trust the numbers that a broker provides, or do you need to do your own due diligence to make sure they're right?
No, I would go to the source. I would go to the T12, the financials from the seller.
Okay.
Yeah, because this is just, again, here at this level, it's like high level, and you're trying to filter and see, is there potential? That's the question, basically. Is there potential? Is there enough juice in that deal to take a deeper look?
Mm-hmm. So what about the Berkaria pro forma? So those are numbers that you calculate as an investor, or how do you get those numbers?
They're going to be part of the offering memorandum.
Oh, from the investor.
From the real estate broker. Let me see if I can find an example, or the example actually I used for this one. Was it this one? Yeah, so I can share the screen actually. This is an offering member on a property. And that must be this one actually. So they're showing like pictures. It's like a whole book. What they say here, they spend money on the property. Look, oh, they have nice finishing. And that's your upside, right? So they're talking here. So you can get washer and dryer, technology package, Tiffy. And this is how you can increase revenue on the property.
Much of
Right.
it is forecasted income based on the work you're going to put in.
Yeah. So they're talking about the market. They're talking about all these things. But that's why usually market more.
That's why it's so important to confirm this pro formas with a property management company that you're going to work with, because if they're saying you could get $50 of rent for additional washer dryers in per unit, then you got to confirm that. Because if the nearest ones are $25, that NOI multiplied by 250 units, there would be a deficit there. So that's why it's so important to confirm these pro formas, and maybe a property management company can do a pro forma as well to confirm this potential income. Granted, it's used historic, like the T12s, the trailing 12s, or trailing 6. So it's a lot of math that's used there and a lot of confirmation.
Okay.
Yeah, so that's how they would lay out the information in the pro formas, like made it a little smaller.
So T1 is so T12 is the trailing 12 months. T3 analyzed as past 3 years. Is it? What is that?
T3 means 3 months.
3 months. Okay.
And annualized, so they multiply by 4 the last 3 months.
Okay.
And T1, they take the last months, they multiply by 12.
And multiply by 12. Okay.
Yeah. And here, see the difference. That's why I brought it up. But see, Berkelia, they're going to have access to kind of industry, or let's say region-wide typical expenses for properties. That's what they're going to put in their expense pro forma. What's interesting is pretty close to how this property was running on a T12 level. Maybe except they didn't have a replacement reserve. So they were even a little higher, if you think about it. But sometimes, usually we would look at normalized numbers. So is it reliable? Good brokers, they're going to provide pretty reliable numbers on that. But like Fred said, today we're in a context of high level. So when you do a deeper analysis, and certainly before to place an offer, you're going to want to confirm these numbers. And usually they also give you a bunch of assumptions, and they explain to you how they came up with the different numbers. See, payroll 1,200 units a year, that's very typical as a rule of thumb, etc.
Yeah, so the thing about, when I looked at the payroll, I saw year on year that never changes at all. It probably is not a good assumption, because you have to give raises at least once a year to staff and stuff. So at least a 3% increase in payroll is a reasonable assumption.
This is year one. So the pro forma that you're going to be shown here is year one. But after, when you do your own, I can give you a glance at an example here. So for instance, we would work on year one, but also year 2, 3, 4, 5, etc., or whenever until you sell. And then you're going to say, what's your rent escalator and what's your expense escalator? But now, like, all these numbers going from year 1 to year 2 on the expense side, they add 3%. That's the way you would take care of that. Okay. If there are no other questions, we will move to the typical, what I call a quick valuation. This is coming from the syndicated deal analyzer from Michael Blanc. We use a modified version of that tool. Though I don't use too much this, but it's an interesting thought experiment nonetheless. And for a very quick valuation, you don't, I guess 2 minutes, if probably need less. If you enter the gross potential income as a parameter, anything in blue, that things you can change. So minus the economic and physical vacancy, which I think 10% as for both is a good number, is a good baseline. So you end up at 900,000 of net income. And then for the expense ratio, also 50%, I think in general, in the nationwide, rather, it's a good number to use. I'm trying to look at, see, for instance, let's take a look at this one, right? Let's look at their T3, T12, right? And let's do the math quickly to see that ratio. And you'll understand my point. So if I do 636 divided by 1500, so net income divided, expenses divided by net income, see about 42%. Right? So it could be, there's a general rule, but then there could be a little bit of nuances. Right? So that's why I'm not a very big fan of this quick valuation, because one of the weaknesses is the expense rate may or may not be, unless you do some research, it will give you an idea. You really have, I think, and there's a comment here like rule of thumb, carefully consider before changing. I would say carefully consider before using 50%. That's, you have to study a little bit. And I know, so quite frankly, this example is a little odd because I think it's in Atlanta, and I think Atlanta is probably 50% is a good number. Yeah, Decatur. Though it could be, there could be something about, in this case, we run the math. It's running at 42%, but an example of why 50% it cannot be used everywhere. Like sometimes the owner is going to pay for utilities, and in older properties, for older properties, the owner would pay for utilities. In more recent properties, it's not the case. It's like everything is individually metered. Right. So that's why the 50% is a little bit tricky just from that standpoint. And another example is if you go and take a look at properties in New Mexico, for instance, they're running throughout at 30 to 35%. So now you need to adapt your expense rate to the market, in other terms. So that's why something to be careful about. And finally, so 50% of 900 is 450. Finally, you look at the cap rate. So the market cap rate, and that's a number you can ask. Like sometimes it's in the marketing package, another name of the offering memorandum, or you can ask the broker, or you can use a report such as CoStar report to have that number. It's a very important number because the definition of the cap rate is cap rate equal net operating income divided by the price or valuation. So if you have two of those parameters, if you have NOI, net operating income, and cap rate, market cap rate, then you can determine the valuation. It's, as I said, I don't use too much that, and it doesn't bring too much value in my opinion. And actually, to do this exercise, it has a tendency to confuse people. I'd rather look at, and it's very similar to the fix and flip mindset. It's almost like this is my after repair value, right? And because I can do XYZ to bring the NOI to that level. And then where is my purchase price to make the numbers work, so I can hit my returns. That's this is not interesting to look at this.
Okay.
It's not. It's a waste of time. And next, another thing to consider, I think it's also part of property analysis, because like we just mentioned a minute ago, you're going to increase the NOI. You want to force appreciation by increasing the NOI because of that relationship with the cap rate. And if you increase the NOI, the net operating income, then you will increase the value of the property. So very usual, typical way to achieve that. And I would say, I would argue the number one way to achieve forced appreciation, to increase rents at the end of the day, is going to do renovations. And say here it's an example. You do quartz countertops, stainless steel appliances, shaker cabinet, black faucets and whatnot. So here you want to make sure that you're going to get returns on your investment on these renovations.
Yeah.
So because, and let me go through the formula first. So the ROI, return on investment for renovations, is going to be how much rent bump you can achieve by doing these renovations, multiplied by 12, divided by the cost. And you want that to be greater than 20%. And this is coming from a typical syndication and a very market, let's say a typical deal. And that's actually, we just released one of these offerings recently. The business plan calls for doubling the investment in 5 years. So 100% return in 5 years. So meaning if you do 100 divided by 5, it's 20%. Oops.
So it looks like forced appreciation is probably the lowest hanging fruit to increase the valuation. What else can you do to increase the valuation, to justify rent increases every year?
So, but if you look, so let's look at this. Maybe that's it should be one of the topics actually in the future. That's a good topic. Please make a note.
Yeah.
If you look again, NOI, net operating income, right? We know that's what we want to increase the valuation, right? We just discussed the formula, which was here. The cap rate is NOI and net operating income divided by valuation. That's the formula. And in a given market, there's going to be a common cap rate, right? Every asset is going to be valued at that particular price point. And if you do the math, divided by valuation, you'll have, it's not going to be perfect, but it's going to be around the same number. As an owner, an operator of that particular property, you're going to look at how can I increase the value? This is fixed and it's determined by the market. I cannot control it. The only thing I can control is the net operating income.
Yeah.
So if I go, if I go here, net operating income is going to be income, and we can go a little bit in detail in a second, and expenses, right? So what can you do to increase NOI? Income minus expenses. Rents, 100%. Yes, that's the top line here. And maybe I can zoom in, right? So that's the positive or after. So if you reduce VIC, non-revenue units, that's positive. The rent grows, that's your renovations, right? So that's one way to increase, but you can decrease any of these negative numbers that will have a positive effect. You can increase fees. You can increase RUBS, which is it's where you charge the utilities, I forgot what it stands for, but it's an acronym.
Okay.
And you can charge for other washer and dryer. I think maybe they were talking about earlier. It could be preferred parking, covered parking, valet trash. There are many different small things like that, and I think it's a very
services that
discussion.
So
that's on the income side.
So something about rubs, just consider, and I know this is not a deep dive, it's a high level view, but rubs is not, you can't do it in every state. There's certain states that allow rubs. It's just like the utility billing system that's external. So when a property doesn't have individual meters for each unit, they use a system to try to calculate cost or expenditure based on the unit per unit. So it's not legal in every state. It's a ratio utility billing system or something like that.
Yeah, I think so. So similar thinking about expenses, and anything can decrease expenses. You're going to try to work on that. Taxes, again, that's not much you can do about that.
Yeah, but I think here they're being conservative and not reducing anything, right?
Yeah, insurance, again, that's something you cannot control. Replacement reserves, that would be a lender requirement, so something probably you cannot control as well. Utilities, what's interesting, you can put like low flow faucets and toilets, etc., and showers. That could be a way to decrease the expense, because even if you do rubs, actually, if you look at it, rubs, they're doing 56, and in expense, they're doing 63 here. Electric and gas, there will be, some of it will be common space, common areas. If you look, you don't capture the whole amount that was spent on the utility. But I think like a big, see, the big numbers is what's going to be payroll and repairs and maintenance turnover. Those are the big numbers that you can control to some extent. And I would say I'm a little bit 600. An example. Yeah, usually I do for repairs and maintenance turnover plus contract services. Yeah, I do 1,000. Yeah, 1,000 is that's what I have in mind. But again, if you do a lot of capex, so if you do a lot of renovations, I would argue that this number, at least for 1 or 2 years, is going to be much lower. So that's typically how I actually, with my example here, you can see that my repairs and maintenance turnover, it was half what I have here. I went double these amounts. Just as an illustration. Yeah, and that's it. So now you have, that's the idea, that's the concept there. I think I didn't have anything else.
Actually, it's 7:45, so if you want to just...
We already spend much more time than I expected.
If you have any questions, you can ask too.
Paul, we are all ears if you're still with us, unless you fell asleep. Oh, there was a lady who joined earlier. She got scared.
Red. Yeah. All right, Paul, are you still there? Okay. All right. Well, you may have stepped away. So I guess this pretty much wraps up today's presentation. This will be sent out to anybody who subscribed. It will go out on the newsletter as well for folks that are still not aware of the RIA, the Real Estate Accredited weekly meetup. It's brand new. We're slowly making progress, getting people to attend. There's no more questions. Let's go ahead and end the session. And thank you for taking time and hanging out with us.
Thank you.